There's a charge on your life that never shows up on any invoice. It doesn't appear on your bank statement, it's not a line item on your tax return. Nobody sends you a bill for it, but every single month, quietly, consistently, it gets collected. And the people it hits hardest are the ones who already feel like they're doing everything right. You budget, you track your spending, you cut where you can, you watch the videos, read the articles, do the mental accounting at 11 p.m. before you fall asleep, and it still doesn't quite add up the way it should. Here's what most people never get told: it's not adding up because the math was never designed to work for you, not specifically, not the way you're living now. There's a name for what I'm describing, we'll get to it, but before we do, I want you to sit with something for a second. Think about the last time someone told you that being single is just a phase, a temporary financial inconvenience, something you'll figure out once your life comes together, like the solution to your bank balance is a wedding. Marcus heard that his whole adult life. He's 31, he lives alone in a one-bedroom apartment in a mid-sized city. He earns a decent salary, not exceptional but solid. He doesn't overspend, he meal preps, he doesn't buy rounds for 12 people at the bar. By every conventional metric of financial behavior, Marcus is doing well. And yet, somewhere around the third week of every month, the numbers get tight, not dramatically, just enough to notice, just enough to make him wonder what he's missing. What Marcus is missing isn't discipline, it isn't income, it isn't a spreadsheet. What Marcus is missing is a partner, not emotionally, financially, and the difference between those two things is the entire point of this video. Because here's what nobody ever frames clearly: being single in 2026 doesn't just mean navigating life alone, it means paying a structural premium for that life. A premium that has been baked into the pricing architecture of almost every major financial system you touch: housing, taxes, insurance, travel, retirement. And by the end of this, you're going to have a real number, not a vague sense that things cost more. An actual figure for what this premium costs the average single person every year in 2026. Hold on to that, because we're going to build to it carefully, and when we get there, it's going to land differently than you expect. Let's start with something that sounds simple but isn't. Why does a one-bedroom apartment cost what it costs? The obvious answer is supply and demand. Location, square footage, building amenities. Fine, but here's the layer underneath that: rental pricing in most urban and suburban markets is structurally calibrated around the assumption of shared occupancy. Not officially, not in the listing, but implicitly in the numbers. The average two-bedroom apartment in the US in 2026 costs roughly 35 to 40% more than a one-bedroom in the same building. Not twice as much. 35 to 40% more. Which means two people splitting a two-bedroom are each paying somewhere between 30 and 40% less per person than someone renting a one-bedroom alone. You're not just paying for one bedroom, you're paying the single supplement. In major cities, and this number has been tracked across New York, Chicago, Los Angeles, and a dozen other metro markets, the average single person pays between $6,000 and $11,000 more per year in housing costs than their coupled counterpart on a per-person basis. Not because they chose a more expensive place, because the math of shared housing simply doesn't apply to them. That's just housing. Now add utilities. The fixed costs, internet, electricity base rates, water minimums don't scale proportionally with one person. A couple splits a $120 internet bill. A single person pays $120 alone. A couple splits a $90 electricity base charge. A single person pays $90 alone. The fixed cost of being alive in a modern home doesn't halve because you have the number of occupants. It stays roughly the same and gets split by fewer people, or in Marcus's case, by one. This isn't news, most single people feel this. What they don't feel is how it compounds. Here's where it shifts. Most conversations about the financial cost of being single stop at housing and split bills. That's the surface. That's the version of this conversation that gets dismissed because it sounds like complaining. What doesn't get talked about is the second layer, the one that's harder to see but significantly larger in real dollar terms. It's the pricing architecture of systems that were designed, not accidentally, around the assumption of partnership. Let's start with taxes. In the United States, the tax system still carries the structural fingerprints of a mid-20th century assumption that the default household unit is a married couple with one primary earner. The marriage bonus, where two earners in a household face a lower effective tax rate together than they would separately, isn't a rounding error. It's a feature, and it's a feature single people are systematically excluded from. In 2026, a single filer earning $80,000 a year pays federal income tax at an effective rate roughly 2 to 4 percentage points higher than a married filing jointly household with the same combined income split evenly. That sounds small. It isn't. On $80,000, that's $1,600 to $3,200 a year, every year for as long as you're single. Not because you did anything wrong, not because of a decision you made, because of a marital status you don't have. There's a name for this, by the way. Economists have called it the singles penalty. Some call it the singles tax, but I want to use a different term, one that I think captures what's actually happening. We'll get there in a few minutes. Now I want to talk about insurance, because this is the layer most people don't think about until it's too late. Health insurance for singles without employer-sponsored plans is priced individually. A couple on the same plan splits the premium between two people, and employer contributions where they exist often cover a larger proportion of the family premium. A single person absorbs the full individual premium alone. This gap has widened. In 2026, the average individual health insurance premium in the U.S. sits between $450 and $600 per month on the open market. A couple on a family plan paying $900 to $1,100 a month is paying $450 to $550 per person. The math is almost identical, but the structure is different. More importantly, life insurance, auto insurance bundling discounts, home insurance couples pricing. These industries were built around household units, not individual units, and the individual unit consistently pays more per person. Add it together, just housing, the singles tax, and insurance premiums, and you're already looking at $9,000 to $15,000 a year in structural premium that a single person at median income pays compared to their coupled equivalent. Per person. That's before we get to the number. And before we get to the number, I need to address something, because I can already sense the objection forming. You're thinking, okay, but single people have fewer expenses overall. No shared family costs, no dependents, no partner's debt to absorb, no compromise on the apartment you actually want, the freedom to move, the freedom to spend purely on yourself. All of that is true, and it's exactly the framing that keeps this conversation from going anywhere useful. Because this video isn't about whether being single is better or worse than being partnered. That's a lifestyle conversation. This is a structural one. The question isn't, does a single person spend less in total? The question is, does a single person pay more per unit of life, per dollar of housing, per unit of insurance coverage, per dollar of tax liability, per retirement contribution than an equivalent coupled person? And the answer to that specific question is yes, consistently, measurably, and regardless of what the single person does with the surplus from not having dependents. The premium exists whether or not you feel it, whether or not you're happy, whether or not you're choosing single life intentionally or just living it for now. This isn't about the emotional experience of being alone, it's about the financial architecture underneath it. And once you see the architecture, you can't really unsee it. The fact that you're still here tells you something about yourself. You're not looking for someone to validate your spending habits. You're looking for an honest picture. There's more of that coming, and it gets into territory most finance channels won't touch. If that's what you want, you know what to do. Now let's talk about retirement, because this is where the structural premium becomes something bigger than an annual inconvenience. It becomes a decades-long wealth gap. A couple saving for retirement has something a single person doesn't: two income streams contributing to two sets of tax-advantaged accounts, two 401(k)s, two IRA contribution limits, two Social Security earning records that, at retirement, produce a spousal benefit option that a single person has no access to. In 2026, the maximum 401(k) contribution is $23,500. A couple with two accounts can shelter $47,000 from taxation annually. A single person can shelter $23,500. That's a structural difference in wealth accumulation capacity, not a behavioral one. The single person could be maximally disciplined and still have half the tax-sheltered accumulation capacity. Then there's Social Security's spousal benefit, up to 50% of a higher-earning spouse's benefit, available to married individuals who earned less or didn't work. A single person builds their record alone and receives only what they individually earned. There is no safety net of a partner's record to fall back on. Over a 30-year retirement horizon, financial planners have modeled the accumulated difference. The number varies by income level, but at median income, the structural retirement gap between a single person and a coupled person, accounting for dual contributions, spousal benefits, and survivor benefits, can reach $200,000 to $400,000 in total retirement wealth. Not because the single person saved less, not because they earned less, because the system compounds the advantage of partnership in one direction for 3 decades. This is the number I told you we'd build to, and it's bigger than most people expect. Not $9,000 a year, which is already significant. $200,000 to $400,000 in lifetime wealth, quietly, systematically transferred away from the person who was never part of a household unit. That's the real cost of the loneliness tax. And now, after all of that, let's name it properly. The loneliness tax is not a metaphor. It's not an emotional concept. It's a real, calculable premium that the modern economic system charges for the experience of being a single-occupancy life in a two-person infrastructure. It shows up in housing, in taxes, in insurance, in retirement accumulation, in the pricing of travel, which charges single supplements on cruises, tour, and hotel rooms designed for double occupancy, in the pricing of grocery staples that are portion-sized and priced for multiple people, in the invisible cost of every system that was calibrated for partnership and never recalibrated when the demographics shifted. And the demographics have shifted dramatically. In 2024, for the first time in American recorded history, single-person households became the most common household type, surpassing couples with children, couples without children, and multi-generational households. 28% of all American households are now one person living alone. In cities like Washington, D.C., Atlanta, and Denver, that number is closer to 40 to 50%. The loneliness tax is now being paid by a plurality of households, and the infrastructure hasn't moved. Marcus closed his banking app for the 11th time this month without transferring anything to savings. Not because he spent too much, not because he doesn't understand compound interest, not because he needs a budgeting course. Because the fixed costs of his life, rent, insurance, utilities, his tax rate were calibrated for a household that isn't his. He's not behind, he's just paying the tax. So what do you do with this? Because the honest answer is, you can't opt out of most of it. The tax code is the tax code. The rental market is the rental market. You can't individually renegotiate the pricing architecture of the American economy. But you can stop diagnosing yourself as the problem. That shift matters more than it sounds. Because when you understand that the gap in your finances is structural, not behavioral, you stop wasting energy on fixes that don't address the actual mechanism. You stop trying to out-discipline a pricing system. You start making strategic decisions that account for the real cost of your life as it actually is, not as a temporary holding pattern until something changes. Specifically, and these are actionable, there are a few places where the structural premium can be partially offset. The first is housing structure. Not cutting back on your apartment, but exploring house hacking, co-living arrangements, or intentional roommate situations that let you split fixed costs without requiring a romantic partnership. The economics of shared housing are available to single people who structure their living situation deliberately, not as a consolation prize, as a financial strategy. The second is tax optimization. The singles tax on federal income is real, but HSA maximization solo 401(k) accounts for self-employed individuals, and strategic Roth conversions in lower-earning years can partially close the gap that the standard tax structure creates. A session with a tax professional who understands the singles premium is worth every dollar. The third is retirement architecture. A single person cannot access spousal Social Security benefits, but they can structure their savings to compensate. That means higher personal savings rates earlier, understanding survivor benefit designations for single people, and in some cases, considering whether annuity products offer the longevity insurance that a surviving spouse's income would otherwise provide. None of these are perfect substitutes. The structural premium is real and it doesn't fully disappear, but knowing the mechanism is the beginning of addressing it. The loneliness tax is real, it's measurable, it's not your fault, and it's not going away on its own. But here's the last thing I want to leave you with, and this is the part that doesn't get said anywhere near enough. The financial system was built for a world that increasingly doesn't exist. Nearly a third of all households are now single. The mismatch between the infrastructure and the demographic reality is growing, not shrinking, which means the conversation about the loneliness tax is going to get louder, not quieter, in the years ahead. You're not behind the curve on this. In some ways, you're ahead of it, because you now understand the mechanism. And understanding the mechanism is what separates the person who spends the next decade wondering why the math doesn't add up from the person who builds a financial life that actually accounts for the life they're actually living. You came here because something felt off. It wasn't you. It was the tax. If this changed how you see even one thing about your financial situation today, you're already thinking differently than most people around you. This channel goes deeper into the money truths that don't get said clearly anywhere else. No motivation, no generic advice, the actual numbers, the actual structures, the actual picture. Stick around, there's a lot more to understand.